Yesterday morning, one number came out of Washington that was not widely anticipated. And in the hours that followed, something happened to gold and silver that even the most seasoned analysts covering these metals for decades had not seen coming in a single session. Not because the move was impossible, but because the speed of it, the size of it, and the specific conditions that had to align simultaneously to produce it are the kind of thing that happens once in a very long stretch of market time. And when it does happen, the people who were watching the right things understood it instantly. The people who were watching the wrong things are still trying to figure out what they missed. Here is what you need to know right now. Gold is trading at $4,175, up 1.53% today alone. Silver is sitting at $62.40, up 2.87% on the session. Both metals closed last week near their lowest levels in months. Both metals are now in the middle of one of the sharpest two-day reversals in what has been a challenging quarter for this entire asset class. And the reason behind it is sitting in the jobs data that printed yesterday. 110,000 jobs were expected. 57,000 actually showed up. That miss is not just a statistic. It is a fundamental structural shift in how the Federal Reserve's entire rate path looks from this morning forward, and everything that has been pressuring gold and silver for the past 6 weeks. The rate hike expectations, the dollar strength, the rising opportunity cost of holding non-yielding metals, all of it just repriced in the direction this market needed. The noteworthy part is not that it happened. The noteworthy part is what comes next. For anyone who was watching the right data the entire time and held through what just happened, this is Senior Life Academy. We are back after a period of transition with this community. We are rebuilding. And this is exactly the kind of moment this channel was built for. Drop Senior Life Academy comeback in the comments right now and tell me where in the world you are watching from. I read every single one. And if you want the real data before it becomes the headline, the Telegram link is in the description. That is where this community gets updates first. Now let us build this properly, because a big move in a single session is not a thesis. It is a data point. And to understand whether what just happened is the beginning of something genuine or just a relief bounce inside a continuing sell-off, you need to understand exactly what broke, what changed, and what still has not changed. Let us start with the number that shifted the entire narrative. The June payrolls report changed expectations toward a softer Fed path. Non-farm payrolls rose just 57,000 in June, well below the 115,000 consensus. It is the lowest job gain in 4 months. April and May payrolls were revised down by a combined 74,000. That revision matters as much as the headline miss, because when the 2 prior months also get marked lower, it tells you the labor market has been cooling longer than the data suggested. Not just in June, but across the entire second quarter. The data was weak enough to push the dollar lower and pull the 10-year Treasury yield down to 4.465%, but not clean enough to force an immediate Fed pivot, because the lower unemployment rate still points to limited layoffs. The unemployment rate unexpectedly fell to 4.2% as workers left the labor force, while wage growth edged up to 3.5% year over year. That combination, a weak headline with a falling participation rate and contained wage growth, is exactly the mixed print that keeps the September rate hike debate alive without locking it in. And for gold and silver, that is precisely what the market needed. Not a clean pivot signal, just enough doubt about the rate path to begin unwinding the extreme bearish positioning that has been driving both metals toward their lowest levels since last November. Fed funds futures now imply roughly a 50% chance of a September rate hike, down from 67% before the latest employment data. That 17 percentage point swing in probability, triggered by a single data print, is not a minor adjustment. That is the futures market telling you the entire hawkish narrative that has been selling gold and silver for 6 weeks just lost its single most important foundation. Now, let us talk about what this means specifically for the chain of events that brought both metals to where they were at the start of this week. The setup going into yesterday was this. Gold had just printed its hardest quarter since the second quarter of 2013, down more than 14%. Silver had given back more than half its value from January's all-time high, near $122, falling to a low near $57 and change at the worst point of the sell-off. Every week of that sell-off was driven by the same 3 mechanical forces: working in the same direction simultaneously. A hawkish Fed raising rate hike odds, a strengthening dollar making gold and silver more expensive for international buyers, and rising Treasury yields increasing the opportunity cost of holding assets that pay no income. All three of those forces just reversed in a single session. The US dollar index, which tracks the dollar's value against a basket of 6 major currencies, traded around 100.75, hitting a 2-week low. A falling dollar means every international buyer of gold and silver just saw the effective price in their local currency get cheaper. That is demand returning from every single market outside the United States simultaneously, not because any single buyer made a decision, because the math changed in their favor all at once. The yield drop is the other side of the same coin. When the 10-year Treasury yield falls, the opportunity cost of holding non-yielding metals falls with it. The question of whether you should own a Treasury bond, paying 4.5% instead of an ounce of gold that pays nothing, becomes a meaningfully different calculation when that 4.5% yield is falling toward 4.4, 4.3, 4.2. Every basis point of yield that comes out of the Treasury market is effectively a basis point of competitive pressure being removed from precious metals. And layered on top of all of that, there is the Iran and Hormuz situation that has been evolving in the background. Gold drew additional support from lower oil prices and easing inflation concerns as commercial shipping through the Strait of Hormuz continued to recover amid progress in US-Iran talks. Crude oil prices continue their downward trajectory in early July with WT ICE sliding below $68 per barrel amid recovering Strait of Hormuz traffic and diplomatic progress. Lower oil prices mean the energy-driven inflation spike that gave the hawkish Fed narrative its most credible justification is now fading. You cannot have a sustained rate hike argument built on energy inflation if energy prices are falling. 3 structural headwinds reversed simultaneously. Dollar fell, Treasury yields fell, oil fell. All 3 of those reversals are generally considered supportive for gold and silver, and they all happened in the same 72-hour window. Now, here is the piece that almost nobody will say clearly on video today because the narrative is always easier to follow than to challenge in real time. This reversal was not random. It was not luck. The people who understood the structural setup underneath this sell-off, the 6 consecutive years of silver supply deficit, the record pace of central bank gold buying, the industrial demand floor that no rate decision can remove, those people were not surprised by this move. They were positioned for it not because they predicted the exact jobs number. Nobody can do that. But because they understood that the sell-off driving gold and silver to 6-month lows was a monetary market sell-off, not a fundamental breakdown. The fundamentals never broke. The paper market broke. And yesterday, the paper market's justification for staying broken got removed. Let me walk through the structural picture one more time, because this is what determines whether yesterday's move is the beginning of a genuine recovery or just a temporary relief bounce that reverses when the next Fed speaker turns hawkish again. The Silver Institute's 2026 World Silver Survey confirmed this year it will be the 6th consecutive annual global silver supply deficit, with the shortfall estimated at 46.3 million ounces wider than the year before. That deficit expanded even though solar panel manufacturers cut their silver consumption by 19%. Mine supply contracted faster than industrial demand fell. That is not a market where the fundamental imbalance is healing. That is a market where the fundamental imbalance is getting worse, buried underneath a 6-week paper market sell-off driven by rate fear that is now partially reversed. The cumulative shortfall from the silver market since 2021 approaches 800 million ounces drawn from above-ground inventories. That is nearly a full year of global mine production that has been pulled out of the buffer pool and cannot be replaced quickly. New silver mines take a decade to develop. The supply response to higher prices is slow, measured in years, not quarters. The demand side, particularly the industrial demand, is not discretionary. Solar installers, EV manufacturers, AI data center builders, semiconductor fabricators, none of them paused their silver purchasing during this 6-week sell-off. They kept buying at whatever price they had to pay because the production schedules are set and the contracts are locked. That is why the Shanghai premium over COMEX stayed elevated above 10% even as the COMEX paper price was grinding lower. The physical market was telling you the fundamental story the entire time. The paper price was telling you the sentiment story. Yesterday, sentiment caught up with fundamentals at least partially. On the gold side, the central bank buying picture has not changed at all. A 2026 survey of central banks found 95% expect global gold reserves to rise this year, up from 81% in 2024. Gold overtook U.S. Treasuries as the largest share of global reserves for the first time in 3 decades. Countries like China and Brazil are still holding less than 10% of their total reserves in gold, meaning the structural buying pressure from sovereigns has significant room left to expand, regardless of what a single jobs report says. JPMorgan's gold target remains $6,000 by year-end. Goldman Sachs cut theirs from $5,400 to $4,900 after the Fed repricing. But even that more cautious call is 17 to 20% above where gold was trading before yesterday's NFP miss. Macquarie's average gold forecast for this full year is $4,641. Deutsche Bank has flagged the possibility of silver reaching $100 by year-end, specifically noting that silver tends to outperform gold hardest in the later, more volatile stages of a precious metals cycle. Now let me talk about where this leaves the gold-silver ratio, because this is the metric that best captures what is actually happening to the relative positioning between the two metals in real time. Silver is up 2.87% today, gold is up 1.53%. Silver is outperforming gold. That is not a coincidence, and it is not noise. That is the gold-silver ratio beginning to compress from its recent stretched levels. The ratio had widened from a low of 50 to 1 when silver was at its all-time high in January, all the way back towards 69 to 1 at the worst point of the sell-off. During the Iran conflict concerns earlier this year, it briefly stretched past 85 to 1. The 50-year historical average sits between 65 and 70 to 1. Silver's 2 to 1 outperformance over gold in today's session is the ratio beginning to move back in the direction it has moved in every single previous silver recovery across 5 decades of market history. When monetary fears peak and the structural story reasserts itself, silver runs harder than gold. That is precisely what we are watching happen. Now, here is where I have to be honest about both sides of this, because this channel does not do cheerleading and the story is genuinely not one-directional. The 57,000 jobs number is weak, but the unemployment rate fell to 4.2% and average hourly earnings came in at 3.5% year over year. That combination, job creation slowing, but wages still running, and the labor force shrinking rather than expanding, is not a clean recessionary signal. It is a mixed bag, and mixed bags do not force Fed pivots. They create uncertainty, and uncertainty at the Fed under a chairman who has explicitly said he will not be a prisoner of his own predictions and who has stopped giving forward guidance entirely means the rate path is genuinely unclear rather than clearly dovish. The September rate hike probability dropped from 67% to around 50% on this jobs print. That is a meaningful move, but 50% is not a pivot. 50% is a coin flip. If the next inflation reading comes in hotter than expected, that 50% goes right back to 65 or higher. The relief rally in gold and silver today is real, and it is supported by the data. What it is not yet, is a structural confirmation that the hawkish rate cycle is over. That confirmation will only come over multiple data points, multiple Fed communications, and potentially a jobs report a month from now that continues in the same direction rather than reverting. That is the honest picture. Yesterday's move was the notable catalyst. The 6 weeks of difficulty preceding it set it up, and the structural fundamentals that were true throughout the entire sell-off are still true today. But declaring that the bottom is in with absolute certainty based on a single jobs print would be the same mistake as declaring the bull market over based on a single hawkish press conference. Do not make that mistake in either direction. Here is your monitoring framework for the days ahead, specifically for understanding whether this reversal is the beginning of a sustained recovery or a temporary bounce. Watch the gold-silver ratio directionally. Silver outperforming gold in today's session is exactly the pattern that has preceded every genuine precious metals recovery phase in modern market history. If silver keeps outperforming gold over the next several sessions, the ratio compression is supporting the structural recovery thesis. If gold recovers but silver stalls, the move is being led by macro safe haven demand rather than genuine industrial silver tightness. Watch where gold closes in relation to 4,100. That level capped the initial NFP spike on Wednesday. Breaking above it and holding above it was the first signal of potential structural recovery. Gold traded up to 4,120 as of yesterday's report and is trading at 4,175 this morning. Sustaining above 4,100 matters technically. Watch the dollar index. The DXY fell to a 2-week low after the NFP miss. If it continues weakening, it adds supportive pressure to both metals through the international buyer demand channel. If it reverses and dollar strength resumes, that headwind returns regardless of what the jobs data showed. Watch the next inflation data release because that will determine whether the September rate hike probability stays near 50% or reprices in either direction. A hot inflation print would partially reverse what the NFP miss accomplished. A cooling inflation print would extend it. And watch the Shanghai premium on silver. It has been holding above 10% throughout the entire COMEX sell-off, telling you the physical market remained tight regardless of what paper traders were doing. If the premium begins to narrow as COMEX prices recover toward the physical market level, that is the confirmation that the divergence between paper and physical silver is finally closing in the right direction. Let me close with the only framework that actually matters for anyone who has been holding through this. The sell-off that just ended, at least partially, was a monetary market sell-off. Rate fears drove paper contracts lower. The physical market, the Shanghai exchange, the industrial buyers, the central bank accumulators, they were not selling. They were either holding or buying more at lower prices. The noteworthy thing that just happened is not the jobs print itself. The noteworthy thing is that 6 weeks of genuinely difficult monetary pressure, the kind that makes even experienced holders question the entire thesis, got resolved in a single 72-hour window by 3 converging reversals that nobody could time, but anyone patient enough could position for. Gold was down 14% for the quarter and is now bouncing. Silver was down more than 50% from its all-time high and is now recovering towards $62, with a Shanghai premium still confirming the physical tightness underneath the paper story. The structural case that was true at the bottom of the sell-off is exactly as true right now. The only thing that changed is the monetary market's willingness to stop fighting it. Nobody who understood the structural setup was surprised that the reversal came. The surprise was only in the timing. And timing in markets is always the last thing you figure out, not the first. This is education and discussion only, not financial advice. Your money, your situation, your time horizon, your risk tolerance, those are yours alone to determine. I walk you through the data so you can think clearly, not so you hand me the decision. If this breakdown gave you the real picture of what just happened, drop Senior Life Academy, come back in the comments and tell me where you are watching from. Join the Telegram channel in the description if you want this data before it hits anyone else's headline. Invest with logic, never with noise.